Hello and welcome to our market alert video for today, which is November 3rd, 2023. I am Ken Moraif. I'm the founder and CEO of Retirement Planners of America. And our singular goal is to create as many squippers as we possibly can. And SQUIPPER is the acronym for Second Childhood Without Parental Supervision. So anytime a client of ours retires, we tell them they are now officially a SQUIPPER and they have joined the SQUIPPER Nation. And they're supposed to go out and do a lot of squippering. So that's our goal. So thank you for watching. If you'd like to visit with us, our website is below. It's rpoa.com. Let's go over what's going on. And, this has been just a crazy week. And of course, as we've been talking about for many months now, we said that inflation was going to trend downward and bottom in June at around 3%, and that the market would perceive that very well. They would like that, and therefore we would see a nice rally in the market. And in fact, that is exactly what happened. We also said then that the inflation would start to go back up towards 4% into the second half of the year. And that would bring with it what we branded as an inflation shock, okay? Meaning that all the people that thought inflation was under control and taken care of would say, oh, maybe I'm wrong, the Fed's not done. And so we'd see some selling and we'd get a correction. And sure enough, that is exactly what has happened. We saw a correction from the peak in July. The S&P was down 10% before this week, which is the official definition of a correction. Now, what we also said was that the market investors would perceive this as a buying opportunity, because if in fact we look 6 months into the future and say to ourselves the Fed is done raising interest rates, then you know what? The news is good. And therefore, we may have a soft landing, not a big bad recession. And that would be good for profits and good for stock prices. And therefore, investors would start buying. And sure enough, that's exactly what we've seen this week. Now, the big news was what came out this morning, this Friday morning, and that is the jobs numbers. And of course, they came in, I guess you could say that it was bad news because they came in worse than expected. But in today's world, bad news is good news, because if jobs are slowing down, then inflation is going to slow down too. And if that happens, then the Fed doesn't need to raise interest rates. And it's all this snowballing effect of good news based on bad news. So it's a kind of an upside down world when you think about how investors think and how the market behaves. But many times that's the way it works. So our view still is that the stock market right now we're very optimistic about it. We think we're still in a bull market and it'll continue into next year. Now, on the bond side, despite the fact that bonds reacted very favorably to the jobs news, we're not ready to make that decision, but it is becoming now more attractive to look at the bond market than it has been for over a year and a half now. As you guys know, we've been out of bonds since April of last year, and that's been a good thing because bonds have experienced literally the worst bear market, according to Bloomberg, in bonds since 1787. Not 1987, 1787. And only because that's when they started keeping records. It may even be worse going back even farther than that. But be that as it may, we're looking at bonds more seriously now than we have in quite a while. So we'll keep you posted on that side of it. So again, thank you for watching this video. We'd love to meet you and see if there's a fit for us to work together. If you're over 50, if you're retired or retiring soon, go to our website. It's rpoa.com. We got lots of stuff on there that I think you'll benefit from, and certainly the ability for us to meet and see if there's a fit. All right, so share this video with your friends. Thank you for watching, and we will talk soon.